Just about every 6 months, we have Michael Zuber on the show to talk predictions about the real estate market. And that's exactly what we're doing today here on the Fearless Investor Podcast. Hey, everyone. Welcome into the Fearless Investor Podcast. You're listening to me, Kyle Stanley, and we are talking today with Michael Zuber, the One Rental at a Time host. He's got a podcast channel and a YouTube channel. And if you are not already following him, if you don't know his story, I'm just going to encourage you, just go to his channel. There's tons of content, tons of information, especially about where he came from. I also have a couple interviews with him back when I first started this podcast, right around like July, August of 2019. You can find those with Michael Zuber and you can hear his entire story. He has over 200 rentals today in the Fresno market alone. And oh, by the way, he's never spent a night in Fresno. He lives up in the Bay Area. And whenever he comes to Fresno, it's just a day trip. So pretty wild, pretty amazing story. But what I love about this episode is that he has some real research, real data, and real experience going back to the 2007, 2008 period, and some positive news for you about why he thinks that this is not another 2008 coming up next year in 2021. So he's going to tell you a little bit about that. And if you have not already, before we jump into this episode, make sure you're already subscribed to this channel on YouTube, you're subscribed to this on the podcast, you're reviewing the channel, or you're commenting on the video. We would love to be able to interact and engage with you, and just continue to hear from you what you want to hear more about. Is it Airbnb? Is it stuff like this, predicting the real estate market? Is it about multifamily? Is it about wholesaling? Like, what do you want to hear? We want to know what you want to hear. And obviously, I love talking Airbnb. I love talking real estate in general, but I want to know what you want to hear. So the best way you can do that is either leaving a comment or a review on our page. You can also DM me on Instagram. I love connecting with people on Instagram at FearlessKyle. So check out all of those options there. And of course, our website is fearlesskyle.com. Would love to see you on there too. But either way, we're going to talk 2021 now with Michael Zuber. All right, guys, welcome into another episode of the Fearless Investor Podcast. We're talking to Michael Zuber for One Rental at a Time. If you're watching on YouTube, you can see that sign right behind him. If you are not already following Michael, if you haven't heard any of the episodes that we've had with Michael, it's always a pleasure having him on because this is one of the smartest individuals I know. He researches and researches and researches. That is his passion, is just understanding everything that's going on from real estate to stock market to everything. And for that reason, I'm really excited to bring you some hopeful news from Michael's voice today. And we're going to talk a little bit of predictions for 2021. But Michael, thanks for jumping on with us, man.
Hey, Kyle, thank you very much. That's very nice to say. I could say I've been looking at this stuff for 20 years every day. I'm not always right, but I do always have an opinion. So this sort of comes with the territory.
Yeah, well, and I really want to encourage people to follow your channel. We're not really going to talk a whole lot about your story today because we've really talked a lot about that, and you're very vocal about your path to success with One Rental at a Time. But I want to go back to March for a second because you were at that point very convicted that things were going to take a quick turn down. Mm-hmm. And I believe you said from like that point to probably like August, we were going to see this big change in real estate on a downturn. But at least in our market, especially in Fresno, we actually saw, this lull, and then it was like this big uptick. Looking back on what you thought then and then what actually happened, where do you think that disconnect was?
Yeah, that's a great question. I've thought about that a lot. And there's really kind of two factors that I missed. So first and foremost, I nailed the consumer. Q2 GDP was down over 30%. The consumer saved. The consumer retreated. So what I saw coming, step one of the dominoes falling, happened.
Okay.
My failure was where domino one fell, it missed domino two, because my connection was, okay, consumers stop spending. And by the time I made those calls, the CARES Act had not come out yet, right?
Right.
People getting goosed up unemployment, the Fed coming in and saving the commercial loan market. So I did not see the whole don't bet against the Fed, right? Because when I was talking in February and March, right, I was looking at my nearly 200 doors going, shit, what happens if 50% of the people don't pay? I mean, that's
right.
where I was mentally,
right?
And at the time, it was certainly an option. that all came off the table when the federal government CARES Act came out and said, we're going to add $600 to unemployment.
Mhm.
We're essentially going to pay people to stay home. That's what happened. So once that happened, it took a depression off the table. Because before the CARES Act, a depression was not only a possible outcome, it was a likely outcome.
Yep.
Right? We told 20%, 25% of our workers to stay home. You're not essential, right? That's what we told them in the lockdown. And I was so fixated. I was a landlord. I saw what was, I have, C-class apartments, Section 8 apartments, and some B-class. That's where I play. And I'm like, damn, a lot, because I have their applications. I know where they work, right?
Right.
I'm like, ooh, half my tenants could be out of work in 60 days. So the first thing I missed is the CARES Act. Didn't see it coming. Didn't see 3.2 trillion or whatever came out. I never thought we would essentially double unemployment benefits. An extra $600 a week is meaningful.
Yep.
I mean, many of my tenants who are unemployed were actually making more money being unemployed.
Isn't that crazy?
So
Yeah.
I didn't see that coming. So shame on me. I missed that. Right. So that immediately took the depression off the table. But there was another thing I missed. And this only became obvious kind of in July and August. So the CARES Act was the first thing I missed. But the second thing I missed was urban flight. I did not appreciate people leaving New York and San Francisco from their shoe boxes at $4,000 a month to the suburbs. The work from home trend started as rating. So we are seeing people leave San Francisco and go to Fresno, for example. I believe
Right.
Fresno is going to be one of the hottest markets in California for the next 5 years. Because again, if you have to work in the city, you can take a puddle jumper, a flight, or you could just drive. It's an easy drive, right? If you had to go to the office 1 day a week, great. Live in Fresno. You can have $1 million house on a lake, or you can have a 1950s shack in the Bay
Right.
Area. So quality of life, space is good. And then the millennial buyer, right? The millennial buyer is something that I believe started in 18, but is accelerating because of this crisis. So really what I missed is the CARES Act, didn't see it coming. And then all of these buyers that used to be renters flocking to Fresno, again, a market I'm happy to own rentals in, fundamentally changing the market. So yeah, I missed several things.
Yeah. Here's the thing though, is that we all were going through stuff brand new to us, and all we could do is guess and speculate. And when of course the Fed dropped rates, and like I'm hearing as low as like 2.5, it's just it's crazy. There's this big idea, right, of like that fear of missing out. Oh my gosh, rates are so low, I feel like I have to buy right now. And I think that there's a lot of people like that, and especially with low inventory across really what it seems like across the nation, that becomes a really great opportunity for sellers. So let's talk about for a second 2021. You mentioned, you think Fresno's gonna be hot, but what about across the nation? People are
Yeah.
talking about, they think it's 2008 all over again. You don't see that at all.
Yeah, so there's really a couple of answers to that question. So first and foremost, let me come out and say this is my current prediction. And again, as we've just talked about, I'm wrong all the time, but I have an opinion, and it's at least an educated and a well-intentioned opinion. I think we're in for a very tough quarter. Q4 is going to be tough. I believe Congress has failed us. What happened? Where the CARES Act was successful in Q2 and staved off a depression, it's seemingly they're not going to come to an agreement even on a skinny deal. And all of those CARES Act policies will expire between the 27th of December and the 1st of January. And the pain that the CARES Act hid is going to become obvious in January.
Okay.
Now, on the good side, we have given scientists and smart people a chance to develop vaccines. So there is a light at the end of the tunnel. Call it April, call it May. Sometime in there, we are finally going to get back to the ability of being close to normal. But that doesn't stop Q4 from being painful. I think there's a good chance that Q4 is a negative growth and Q1's negative growth. But that's where the pain ends. I believe 2021 will be a positive growth GDP. I believe 2021 will be 5% or greater. I'm actually pretty optimistic about the US economy in 2021. Why do I say that? Well, it's because I've been studying the consumer for 20 years. The consumer has retreated. What did we see in Q2? They retreated. We saw savings rate over 30%. Well, guess what happened in Q3? We don't save well, man. We spend. So while we had a 30% drop in GDP in Q2, we had a 30% spike in Q3. So I believe Q4 will be soft. I believe the early parts of Q1 will be soft. But we are going to come out of this. We are going to travel again. We are going to be excited again. We're going to want to see families. We have missed birthdays and graduations and vacations. And boy, we are going to come out of this. The federal government is going to do an infrastructure bill. They're eventually going to do a stimulus plan. I believe they will make up, like, for example, I don't see a stimulus bill getting done until inauguration, until the end of January. What will happen then is sometime in February, there will be a $1 trillion bill passed, and they'll say, you know what, we're going to make up for what was missed in January. But that's still going to mean January sucked, December sucked. But again, I think 2021 is positive. I do not see a real estate crash. I am very annoyed by all the real estate pundits out there who are saying, hey, look at prices in 2020 and look at prices in 2008. They're the same. We must be set up for a crash. Folks, I lived through that investment. I've been doing this 20 years. I had millions of dollars at risk in the last crisis. It is not anywhere close to the same. First and foremost, if a house is 300 today and it was 300 in 2008, let me tell you what, they're not the same, because the interest rate today is 2.5% and the interest rate in 2008 was 6.5%. The payment is vastly different. And oh, by the way, incomes are up in the last 12 years. So it is not about price. It is about affordability. Yeah. So, and again, these people talking about 3 million people in forbearance and all of these other things, they're trying to scare people with numbers, and it's just not how the dominoes are going to fall.
Yeah. Why do you think they're just as convicted on the other side of this as you are on the positive side? Why do you think they're getting these conclusions?
Well, I think first and foremost, many of them, if you took them in the corner and gave them truth serum, will admit that negativity sells. Crisis, crash gets clicks. There are plenty of real estate pundits out there that are getting tens of thousands or hundreds of thousands of clicks in 24 hours talking about bad news. Mm-hmm. So they're making $1,000 to $10,000 a day preaching bad news. I believe many of them, you'd have to give them truth serum, would admit that. Because being positive about 2021 doesn't get any views.
Right.
I battle this all the time, and it doesn't get any views because nobody wants to talk about it. They're stuck at home. They're in California. They're on lockdown or whatever, and they're just in a bad mood, right? And they just want to go down that path. The second thing is, many of them have only been doing this 10 years or less. If you've only been doing this 10 years or less, all you've known is an up market.
Right.
So you can say this market's different, which it is. But you're comparing it to 10 years of nothing but up. I've been doing this 20 years. I've been through 2 full cycles. I've seen the nuttiness of before and the desperation and the nuttiness and the desperation. So I have more experience. I know what it feels like. We will have a crash. It just won't be in single family. It will likely be in value add multifamily. It's just a different market, right? The lending environment is different. So again, I think most of them are doing it for clicks, and others just don't have the track record, I think.
Yeah. So I was sitting in a room last night with some very experienced.
I saw that. That was awesome. I was like,
it was
shit.
Fun. That was fun. Yeah. And, without naming names, there was a couple of guys in there that had been doing this for 15, 20 years.
Yeah.
One of them said they felt like it was our version of 2005 right now. The other one said it feels more like 2003. So if you were to compare it to 2008, what year do you think you would compare it to?
I think, I would, if you would have asked me that question differently, I would have picked 2004. So I would split the difference.
Okay.
Right. And let's just set what that means. And again, this is Fresno, right? These individuals are experienced in Fresno. That's where my experience is. So play it out from where you are. So my journey starts in early 2001, 2002 in Fresno. And again, I buy a house, I buy another one. And what happens by 2004 is it starts to get interesting. Meaning you're starting to see 8%, 11% appreciation. Oh, by the way, you can go back and look at the numbers. I think it was 05 and 06. Fresno had the #1 appreciating MSA, which is market, for the country 2 years in a row, like 28 and 31%, just nutty appreciation. So that's why I picked 04, because I don't think we're at crazy levels yet, but we are in a good trend. We are having population increase. We're having lack of building. I believe Fresno will see double-digit appreciation for at least 2 or 3 years. So that would make it 04, 05, 06, in my opinion.
Okay. I like
Yeah,
that. I like
that's
that.
that's the way I
So
think.
here, let me ask you an interesting question. You know, you have over, what is it, over 200 rentals?
Almost 200, yeah.
Take yourself back to the mindset of, first couple of years, you've
Hmm.
got anywhere between 0 to 10 rentals.
Yep,
I would
I
say that would
remember
be
it well.
yeah, I would say that'd be the majority of people that are listening right now have either 0 rentals and want to get some, or they have 10 and they're like, man, do I sell them right now? Do I keep
Mhm.
on building? What advice would you give those kinds of people right now?
Yeah, well, I'll tell you exactly. So let's paint the picture. It's 2007. I'm sitting with 8 units, 7 houses, no, 6 houses in a duplex. So seven
Okay.
properties, 8 doors. Let's just set the story. I'm looking for the next purchase, and I'm looking in the same neighborhoods because if you follow one rental at a time, it's all about being focused. So it's not Fresno, it's not even Mayfair. It's 3 bedroom, 2 baths in the Mayfair, right? I'm hyper focused. I had to do it, right? I had 10 minutes a day, so I get hyper focused. And let's just tell you what I'm looking at. The first house I buy on Norris Drive was 107. It rents for 1100. Now, fast forward 4 or 5 years later, I'm trying to buy another Norris Drive. They want 265.
Mm.
265. Guess what it rents for? 1100.
Oh,
So I'm like,
nice.
my mind, I'm very conservative. I don't follow bull markets. I want cash flow every time. My Excel spreadsheet, no matter how much I beat it up, can't make that property cash flow,
Hmm.
right? So I'm going, man, what do I do? I have options. I could stop. I could go to Texas, which we flew out to Texas. We spent weeks in Texas, right? Or we can go to meetups and network. And one of the networks meetings we went to, the gentleman talked about multifamily. And again, I'm an idiot. I only know houses. I've only ever lived in a house. That's all I ever thought I could buy. I thought billionaires bought apartments. But this individual says, hey, go look at 5 to 20 units. And if you find one, do a 1031 exchange.
Mm.
So what we did then is we bought Vassar. We bought a 5 unit, 1 bedroom, 1 bath in the good part of town. And we did a 1031 exchange. We sold the house for 264 and we did a 1031 exchange into 5 units at 223. So when the market gets unaffordable, I need cash flow. So I don't want to sell and put money in the bank. I want to sell and move equity where it's more efficient. And
Okay.
at the time it was apartments. So what we did over the course of 18 months is we did 1031 exchanges. We went from 8 to 80 units. So
Wow.
when houses get too expensive, and they're not there yet, but when they do, I'm going to do the same thing. So if you ask me, Kyle, what I'm doing in 2020, it's the same thing I did in '04, why I said earlier. So I'm going to buy as many single family as I can because I see the opportunity to 1031 exchange in 2024 or 2025.
So that's interesting to me because I've heard you say multiple times that you think that the multifamily industry is going to get hit
Mm-hmm.
first. So
Oh, absolutely.
so what am I missing there?
Well, you're missing timing,
Okay.
right? Multifamily or commercial properties, the reason they're going to get hurt is they do not have fixed rate 30-year debt like residential. So they have 3, 5, 7, or sometimes 10-year terms. And what happens as they go to that reset period, many people just figure, hey, I'll just refi, right? Which has worked for the last 10 years. But when rental rates go down or value add is a little rougher and you have to reappraise and a cap rate goes from 5.5 to 7, right? The value of the asset goes down and the bank is going to go, we'll loan you money, but you got to bring 30% to the table because they're always going to be at 65% LTV of current value.
Mm-hmm.
So what's going to happen is multifamily owners, when they have to go refi, they're going to have a rude awakening and they're going to have a choice. Do they want to bring, I mean, let's just use real numbers, right?
Yeah.
So I sold an apartment building for $1.5 million in 19.
Okay.
We needed 200 grand to work immediately in all of this. I'm sure the person who bought it got 3-year interest only debt. It's the only way the deal would have made sense. They likely came in with 30%, right? So they got a 70% LTV. So they had to come in for, let's just round numbers. They have a loan of $1 million on a 1.5 asset.
Okay.
Let's say 3 years from now, right? Rental rates really haven't moved because again, what's hot today is houses, not apartments. This building needed 200 grand of immediate capital investment and probably more going forward. The bank's going to come here in 3 years and go, you know what? You bought that at a 5.5% because it's C class. Cap rates in Fresno for C class are now 7. Oh, by the way, your NOI really hasn't changed much. So we're only going to loan you 700 grand this time. And because that was an IO loan, the owner has a choice. They can come up with 300 grand because the bank's only going to loan 700.
Right.
That's the delta between 700 and a million, or they can sell. So they can try to
Interesting.
sell for 1.2, 1.1, because that's the choice. These are the calls that owners are going to have to make. And oh, by the way, if you're in bigger units and you're a limited partner and your general partner bought a 50, 100, or 200 units, some of you are going to lose all your equity. And
Interesting.
I did a call just yesterday with the syndicators who syndicated hundreds of millions of dollars. And he's like, there's already limited partners losing their ass because of that
Okay.
example I just did, 1.5 to 1 to 700 grand. If you have to sell, like, let's just say you sold at 1-1. So you paid off the debt, you're free and clear as an owner. You lost 400 grand, right? Bought at 1.5, sold at 1.1.
Right.
If that was all other people's money, you walk away clean, but your equity investors lost money. So that's
Okay.
why multifamily is going to feel pain, because the debt structure behind them is weak. And oh, by the way, like we talked about yesterday, this is the same thing that happened in residential. Why did '08 happen? And why did '08 happen and '08 got worse? It was debt structure. It was the funny 2 and 28s. The first 2 years at 0.9% interest. After 2 years, it resets to 7, right? The story was, I'll buy and refi in 2 years, so I don't care what the rate is in 2 years. I buy now. It's amazing how multifamily is the same way, and residential's not. 90% of the loans in residential now are fixed 30 years or fixed 15.
Yeah.
The structure
So,
different.
so I want to just reevaluate what you said there and tell me if I'm wrong. But what I understand is that all these people who are buying multifamily, let's call it right now,
Mhm.
in 4, 5, 6, 7 years are going to be at that reset time, and they're going to realize, holy cow, my property is not worth as much as it was when I bought it. And that's when Michael Zuber comes in 1031s and gets those at a cheaper price.
Yeah, I would tell you it's not going to be all of them, because some people come in with, I mean, if you're coming in with 50% down, you're going to be fine, right?
Okay.
Because you'll hold. But because again, this is the problem. And this is why it's so similar to '08, just a different asset class. If you are using interest only debt structure today to make debt service work and pay preferred returns, you're in trouble. There's just no other way around it. You have such a skinny margin of safety that if your cap rate goes from 5.5 to 6, 5.5 to 6.5, which will happen because it's riskier, your refi you're gonna have to do a capital call. You're gonna have to make a choice. Do I let the asset go, or do I ask my investors for an extra $100, $200, $300,000 so we can limp through?
Got it.
Now, again, full disclosure, some lenders, because the lender doesn't want the asset, if the asset is truly upside down, they may choose to extend and pretend. What does that mean? They may take a 3-year IO deal and add a 4th year just cause. But realize that's a Band-Aid on, something that needs a tourniquet. That's a problem. They're going to take over the cash flow. They're going to take over the bank account, right? They're going to really manage that. So I firmly believe, again, I do what I say. I'm buying as many residential properties today as I can, because I see 3 years of appreciation. And oh, by the way, as a landlord, stuff appreciates first and then rents rise. And again, I'm a cash flow. If I can make stuff cash flow this year, they'll cash flow even more
Right.
2021,
Right.
2022, 2023. And then once I see the pain in multifamily, I'll just 1031 again. It worked last time. I'll
Cool.
do it again.
Okay.
And hey, it might be 2026. I don't care. I'll be ready, because I don't over leverage. And again, be clear, I don't bet on appreciation. Everything I buy today has to cash flow today.
Right.
But that doesn't mean I don't see 3 years of appreciation. I do.
Okay. That's a super clear path. I love that advice. I think that the big thing that comes to mind for me, especially when I talk to new investors, they're talking about, hey, I'm putting out mail campaigns. I'm getting on the MLS. I'm talking to sellers. I'm doing cold call. I'm driving for dollars. There's just no deals out there. It's so tough because everyone wants top dollar.
Yeah.
What do you say to people that are new that are having that struggle?
Well, I would tell you, first and foremost, if you can get through the next 6 months, you will have worked through the hardest time in my 20 years. So first off, congratulations for sticking with it. Even for me, it's the toughest market I've seen, and I again have 20 years of experience. The market we are in today is owner occupant driven like I've never seen before.
Mm.
And why do I say that? It's because owner occupants are overpaying because they can. The federal government is encouraging FHA first time buyers. So that's our competition. So if the property is even remotely clean, investors can't play. And again, remember my story. I bought 99% of my stuff off the MLS,
Right.
right? So I am that new investor. And this year, I've only got one deal out of the multiple listing service. And I don't expect to get anything between now and the end of the year. But this will change. The market will not stay this dependent. Fresno has 1 month of inventory today. It will not always be that way. Once people start getting vaccinated, people are people, and they're going to do what they always do. What is not happening today? I believe the number one thing that's not happening today is the move-up buyer is frozen. What's a move-up buyer? Well, they got into their first home because it was all they could afford. They got their kids in school, but now they have a better job. They're making more income. They have a bigger savings. They're higher in the org chart. They can afford more. But that buyer is frozen today. What will happen once people start getting vaccinated, people start traveling, people start having vacations, they're going to go, wow, interest rates are really low. I can sell my house for what? Oh my God. I want to go get that move up buyer. That is what's not happened today. We've added more first-time buyers because of FHA, which is why there's no inventory, but we haven't fixed the move-up buyer. And I believe it's only the vaccine that can fix the move-up buyer. And that's going to make more inventory. It's going to make different qualities. It's going to open up the world. So do your homework. Keep doing what you're doing today. It's almost here. You're almost through the worst part. If you can get to April or May, you're going to see the world is different, and you will have learned so much. You will have learned value. You will have learned what sells. So I would encourage you to keep going. You're almost to the end.
I love that perspective. I love that advice. I love that we can probably talk about this for another 30 minutes to an hour, but we can't because we're coming up at the end of the rope here for this episode. So Michael, where can people find you?
I'm pretty easy to find. Everything I do is one rental at a time. YouTube.com/one rental at a time. Instagram, one rental at a time. Amazon and Audible, one rental at a time. I'm there.
Guys, his YouTube channel every day pumping out amazing content. He's always doing the research and sharing exactly what research he is doing. YouTube is free. His channel is free. Just get on there and start listening. That's why I love having you on the show periodically here, Michael. You just bring so much value and so much knowledge. Thank you so much for helping our audience today to conquer the world of investing. All right, show notes for this one. We're going to go fearlesskyle.com/Michael Zuber 2021. So Michael Zuber 2021 is going to be the tag there on the show notes. And I just think that there's so much here that is encouraging. Usually we're the last time Michael was on the show, we were talking about, oh my gosh, COVID and this new thing it's going to just crash real estate. Today, we're talking about a lot more positive things. He thinks between 2021 all the way to 2024, we're going to see appreciation. We're going to see a great upward market, which is really encouraging. But at the same time, it's for you, the new investor, the person who is thinking, man, it's tough to find a good deal right now because everyone wants top dollar. I think there's some encouraging things that he said there just about patience, about continuing to follow the process, and that the deals will come. And at the end of the day, that's what anything is in real estate, in business, and just life. It's about being patient and being, eyes open to the deals, eyes open to the opportunities, but having to wait until there's that right time. And so keep on doing what you're doing. I guess that's what I'm saying at the end of the day. What Michael shared, I think that's the best advice he had. Just keep on doing what you're doing and the deals will come. Thanks so much for joining us here on the Fearless Investor Podcast. We're helping you to conquer the world of investing. We'll talk to you next time.